think it's I don't think there really is a huge benefit modelling them, to be honest with you. I think you have to have the necessary checks in place around these black swan events. I don't think you can predict, who saw this coming. And, even back in January and February, when we'd seen a reduction in oil prices, most market experts were saying that there would be a floor of, say, $35 a barrel. Well, that was massively breached. That was smashed through the floor. And, when we saw prices well below $20 a barrel. So, market experts who are much closer to the oil industry than any of us are, failed to really see that. So I think, what we've seen is companies perhaps immunizing themselves against those shocks going forward, if they can. And that's always tricky to do, but it's certainly estimates, as far as I'm concerned, have been way off, and I attach no serious blame to people in that, because this is not even a black swan. It's something beyond that. Even 2 months ago, nobody could see the magnitude of this crisis, and taking it away from the obvious, very serious personal issues that are being played out here. When the financial crash happened 2008, and then previously, 87 and other mini crashes. Again, models were never that good at being able to cope and predict those events. So, VAR is a really important aspect of being able to, for regulatory purposes and for keeping on top of the risk that you're taking. But let's face it, in these events, that really goes out the window. But look, if it works 95% of the time, 98, 99% of the time, are we really right to question perhaps the breakdown of these systems when they only work 99% of the time? I would say, still use it. There's still a huge validity into using some of the ex-ante and ex-post risk measures. We're obviously concentrating more on ex-ante. But, if it wins 99% of the time, then surely, that's good enough. No one can control these events. There's been a pressure over the last few years to go into slightly riskier assets, of course, around real estate and around some debt management funds. And of course, they've taken quite a big hit at this time. But again, the absolute and the relative scenario is quite an interesting one. We've seen, much like in previous shocks, where we've seen some devastating absolute returns, but then you've had that caveat of maybe going back to your client saying, look, you've lost X amount on your fund, but you've made relatively against the benchmark, you've made plus 3%. So it's that old chestnut that we've dealt with for years, absolutely relative. How do you get around that? And again, with some of my FX clients, for example, it's a zero-sum game. So it's not somewhere or something you can go to clients, whatever's happening, and say, look, you've lost value, you can put it down to the market, because in a zero-sum game like FX, as an asset class, it's not something you can do. You've seen, certain currencies appreciating 5-10% over the last 3 months, and I've alluded to yen and the Swiss franc that are risk in riskier in times. These are currencies you go to. You've seen a big sell-off around Kiwi dollar and Aussie dollar. So a lot of it depends on the type of asset class that you're in, and again your view on absolute relative. But it is that almost taking away from FX for a minute, on those other more standardized type of products, we've seen a lot of happy fund managers, but at a time when perhaps you're losing 10% of the fund. And going back and showing my age, sadly, I saw this very much, in the late 80s. I was working for a company at the time with a big crash of 87. They lost 30% of the value of their funds, but other managers were losing 40-50% of the value of their funds at the time. So relative, they did very well, but how do you explain to you know, a pension committee that you've lost 25% of the value of that pension fund?